Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb, and today I am speaking with Michael Haigh, Managing Director and Global Head of Fixed Income and Commodities Research for Societe Generale. Well, it has been a fairly eventful start to the year, to say the least, in a move that stunned most of us. U.S. forces carried out the audacious seizure of Venezuela's president, Nicolas Maduro. Now, given that Venezuela holds the largest proven oil reserves on the planet, this has major implications for the oil markets, or rather a lot of people think it has major implications for the oil markets. We're going to get into that with Michael, but also, of course, we are not going to let him go without talking about gold and silver and how we can all make even more money in precious metals. Michael, welcome to Merryn Talks Money.
Great to be here. Thank you.
Okay, now I said that at the end about making even more money in gold and silver because Merryn Talks Money listeners, I think, are quite heavily invested in precious metals. So we will get to that. Hopefully we'll have quite a lot of time for that. But I think we kind of got to start with Venezuela, haven't we? I said in the introduction about the massive oil reserves, the largest on the planet. But of course, at the moment, Venezuela produces very little oil, well under 1 million barrels a day. And this move doesn't really mean that they'll be producing much more in the near future. So maybe there aren't really any implications for oil markets at all.
I think there is something a little bit technical that we have to just bring up before we get into how this affects the global markets. So when we talk about the largest oil reserves in the world, this is what Venezuela says that they have. And actually, when we talk about reserves, we talk about proven reserves, and that has to do with the geology, how likely it is that we can extract this easily, and the economics behind it. So unless the economics make sense, it's not considered to be proven reserves. So when they announced they had 303 billion barrels of oil in reserves, this is when oil prices were roughly $100 a barrel. Now they're at 60. So I don't know the exact proven reserves that they would have, but it's certainly less than 303 billion barrels in reserves, but it's still massive.
Hang on, Michael, can I just stop you there? I want to go back to your definition there of proven reserves. Mm-hmm. Do you mean if it's not economic to remove it, extracted at the current oil price, it doesn't count as a proven reserve?
That's right, yeah.
Okay, interesting.
These things aren't audited all the time. It's kind of a little bit, the beauty is in the eye of the beholder. The SEC actually has very strict definitions as to what is considered to be a proven reserve. But price is $40 lower than when we had the 303 billion barrel number being released to the market is a bit high. But nonetheless, it's still massive. Even 80 billion barrels would be massive. But we have this number of reserve out there. As you rightly point out, that doesn't match what they produce and certainly doesn't match what they export. So you're right, they produce about 900,000 barrels a day right now and export 900 minus 250-ish because that's what they consume locally. Now, that difference, that export number has even dropped further with sanctions. The other thing to point out, of course, is that not all oil is equal, and Venezuela is in a very special place in the sense that its oil isn't just heavy, it's what we call extra heavy. So it's almost like goo coming out of the ground, and that means that you need to add diluent or condensate, or as we keep an eye on, naphtha. So you need to add that into the solution. It comes out of the ground and you even need it to refine. So even if you could manage to change the entire refining industry in the world to use just Venezuelan oil at 303 billion barrels, that would satisfy 8 years worth of consumption. Now, that's not what's going to happen, but just to give you some context on the size of their reserves.
Okay, can I just check with you? So where does that additive come from? I think, as I understand it, comes from Russia into Venezuela at the moment, but could also be imported from the US. Is that right?
Yes. So back in the day, about 300,000 barrels of naphtha was being imported into Venezuela from the United States. That matches about 3 million barrels a day of production. So right now, 900,000 barrels a day is being produced of crude oil and about 100,000 barrels is being imported, of which in the last month we had observation it came from Russia and Singapore, actually, but normally it comes from Russia and China.
Okay, so Venezuela can only be a major oil producer and exporter if it has a symbiotic relationship with an exporter of, sorry, what's it called again?
Naphtha.
naphtha. It could only do it if it has a symbiotic relationship with somebody who produces naphtha.
For its very extra heavy oil. It doesn't have just extra heavy oil. It has the majority of it is extra heavy.
Okay, thank you. And just for context, if we talk about Venezuela producing at the moment under 1 million barrels of oil a day, how much do the really big producers, so the top producers in the world are the US, Saudi, Russia, and they're all churning out well over 10 million, right?
Yeah, I mean, the
More
US
like 20
is
for the US.
13 million barrels a day. Saudi is roughly 9, but they're cutting back on their production on purpose. They could go up to 11. Russia's around 10. So they're pretty small by all accounts.
Yeah, and then after that, you get down to Iraq, Iran,
3 million barrels,
UEA, etc. All three, 4-ish, and Norway a bit below that.
Exactly,
etc. Yeah. So it is possible, in theory, for Venezuela to get up to sort of 2, 3-ish, right? With 3 at its peak.
Oh yeah, for sure. I mean, but the question is how long that would take.
Okay, that's my next question. Yeah. How long, if everything went well for Venezuela? We can argue about what well means, but in this context, let's have well becoming a country that people feel is politically stable and financially stable enough to invest in, and the oil infrastructure is gradually built out, as President Trump would like, using the big U.S. oil services companies. How long would it take for Venezuela to start producing much more?
So if we think about getting to between 2 and 3 million barrels a day, most industry experts would say, without rushing the situation, that would take between 5 and 10 years. If you listen to Donald Trump, he said that his ambition is to actually get these things moving in the next 18 months. Now, it could get moving, but it's certainly nothing to be excited about in terms of barrel. But if we wanted to go back to where we were back in the days of the peak, 3.4 million barrels a day, I'm going to guess 10 years.
Okay, so I suppose the answer to the original question, does the political change in Venezuela mean anything for the oil market? The answer is kind of no.
It doesn't mean anything from a barrel perspective. It definitely means something from a sort of a geopolitical perspective, because within Venezuela, you have China that is very much part of its industry. Russia is very important in the context of supplying that naphtha, and also it's important in the context of, because Venezuelan oil has declined over the years, Russian oil has replaced it because they're quite similar kind of gravity levels, viscosity. So if you change the Venezuelan makeup, you change the outlook for Russia, you change the outlook for China, and then you might get responses from them which create some sort of more geopolitical turmoil potentially, and that then could, as a second order, affect the oil market.
Okay, and there are other things that may affect the oil market at the moment as well. I mean, you say that OPEC has been restricting output, but there is political shifts in Saudi, right, which may change that.
Yeah, I mean, OPEC does what it has originally set up to do, which is to manage the market, reduce the volatility. And by doing that, it's essentially cutting its own production or bringing its production back online. Right now, they are still cutting. They were bringing back a lot of oil barrels last year in 2025. They have cut because they see surpluses rising, demand being quite low. So they have refrained from bringing back their barrels until April. In my own opinion, they're going to have to reevaluate their strategy in April because we're very, very oversupplied. And that's even ignoring Venezuela. Okay. So, yeah, there's a few dynamics at play here. There's another dynamic, of course, which isn't real demand. It's Chinese strategic petroleum reserve buying. Yes. So that's them putting oil into their commercial as well as government stockpiles for quote unquote energy security. That has been absolutely rampant over the last 6 months, maybe even the last 9 months. And that is part of the reason, if not the majority of the reason, as to why oil prices haven't dropped yet.
So, Michael, let's talk more about this Chinese strategic reserve. Why are they building this? What's the plan?
Well, China imports roughly 12 million barrels a day of oil, 12 million barrels a day. They're not a significant enough producer so that they don't have to rely on the international markets. Most of that oil is obviously coming from the Middle East and Russia. Some of it, a little bit, comes from Venezuela. But obviously they're in a very sensitive situation. So they have been building out their SPR, Strategic Petroleum Reserve, and they combine that with their commercial reserves, actually, that belong to the state-owned oil companies. And we guess that they have roughly 1.4 billion barrels in SPR. Compare that to the US, which has probably about 400. million barrels. So it's gigantic. And some people believe, and I think it's a little bit extreme, that this could go to 2 billion barrels by the end of 2026, but probably more like 1.5, 1.6. If you divide those billions by their daily import numbers, they're covered for not just 30 days, they're covered for hundreds of days should anything go wrong. So you have a lot of conspiracy theorists that think, okay, well, what if they invaded Taiwan and the West cut off their supplies of oil? How long could they survive for? Who knows what the motivation is? They'll say they're building their SPR for energy security. There's no rule in place as to how much they must accumulate, but these numbers are gigantic. But at some point, they'll stop buying, and that's what will affect the oil market.
Slight side question. How do you store that amount of oil?
Well, I mean, it depends on where you are in the world. There are natural caverns in the US, for instance. They're called salt dome caverns. They're along the Gulf Coast. So these are natural caverns with very thick salt that has been solidified. So it's a natural storage facility, and it's very cheap to store it there. But generally speaking, you're building these facilities. These could be above or underground storage facilities, which, by the way, is very metal intensive. So these are basically large storage facilities.
Huh. Okay. Amazing. Well, I mean, it seems perfectly sensible for China to do that under the circumstances, wouldn't you say? And obviously they must have much higher reserves than the US if they're going to do it, because the US is such a big producer and China is not. So
exactly.
This makes sense in not necessarily a scary way.
It does. It's just that we've never seen these kind of builds we have in the past with China, which leads to the question of why they're doing it. But without trying to get too deep into that, it's about energy security at the end of the day.
Yeah. Let me ask you about the long-term outlook for oil. I know you wrote an interesting article a while back, about comparing whale oil to oil and about how long it took, even once crude oil was discovered and started to be used, how long it took for people to stop using whale oil. So you say it was about 50 years until it was only negligible supply coming into the US. And of course, you could argue that's because there weren't very many whales left, or it could just be the gradual shift from whale oil to crude oil. And I think the point you were trying to make there was that if an energy infrastructure is set up for one type of energy, it takes a very, very long time to shift it to using a different type of energy.
No, that's exactly right. And by all accounts, back in the 1860s, 70s, 80s, 90s, where we saw this decline in whale oil imports into the US and the growth of the crude oil industry, the infrastructure was a lot more simple, let's say, and the world wasn't addicted to oil. Now, the entire world is set up for oil. In fact, if we did want to transition away from oil, that's certainly likely to happen within the developed markets, but I don't anticipate it happening in the emerging markets. In fact, that's going to continue to grow.
Yeah, I mean, one of the unusual things about the whale oil story, while it's very interesting, is it is one of the few examples of a source of energy stopping being used, whereas everything else has been not a transition but an addition, right?
Exactly.
So we use more wood, we use more coal, we use more oil, et cetera, et cetera. Everything we add on is simply an addition. So with that in mind, the idea that long-term demand for oil will actually fall is up for argument, isn't it?
It certainly is.
That would be very unusual in the history of the world. Very, very unusual.
That's right. And if you look at projections from US oil majors, from European oil majors, from industry associations like the International Energy Agency, for example, the EIA out of the USA, the path of oil demand out to 2050 is just so wide in terms of opinions as to where we go. Some think it continues to grow. Some think it declines dramatically from here on out. My own opinion on this matter, when you look at the vast array of paths that oil could go, is that I anticipate that we peak at about 130 million barrels a day of demand for oil, and then we get a gradual decline starting around 2035, 2040.
What is total demand now?
So that 113 million barrels a day compares to total demand today of around 103, 104 million barrels a day.
Okay, and then a decline from 2035 as we shift to what? Or as global population peaks and declines?
The population angle wouldn't really have a big of an impact there. I think what's replacing oil at that point is natural gas. Obviously, we see a lot of investment in liquefaction and regasification facilities around the world. Natural gas is most certainly the transitional commodity that can be shipped around globally and is a lot more appealing than, say, something like coal. But yes, I mean, the vast majority of what declines for oil by 2035 and 2040 is coming from the developed markets, and that switch to natural gas and alternatives, renewables, etc. But, as I mentioned, if you looked at the growth of demand out of the developed markets, you'd see it coming down in 2035. You'd see the emerging markets still increasing beyond 2035, but the decline in the developed mildly offsets the increase in the emerging markets, and that's why you see the decline.
Interesting. I'm going briefly back to whale oil. There was a supply problem there, right? And I don't know if you remember. I certainly do. The stress over peak oil a while back, where everyone was convinced that we were actually going to run out of oil, there'd be no more discoveries, there'd be no more reserves, and we had to make the transition to other sources of energy, not because of climate or environmental worries, but because we were going to run out of the stuff. And that no longer seems a risk at all. We constantly seem to be new discoveries. And did peak oil just disappear as an idea?
Yeah, I think so, because we went through, in fairly recent history, call it the 2000 to 2015 period of time, where technology really was developed to extract oil that we didn't think we had before, or at least we didn't think we had access to. And what I'm talking about there is shale oil, which is a US story. This was not part of any conversation before the year 2000. Now, I know I'm going back 25 years, but that is relatively recent and is still an incredibly part of the equation. So that wasn't part of the discussion when we were talking about peak oil back many, many decades ago. But it just goes to show, when you're running out of something or prices are getting too high, technology has a way of fixing the problem, and high prices have a way of fixing the problem. So even without delving into technological advancements, if prices start to go up because you're thinking about running out of something, this incentivizes the oil companies to invest more in places where you weren't extracting oil before.
Yeah, well, as they were saying, commodities, right? The solution to high prices is high prices.
Exactly.
We could leave oil now, but stick with energy and move maybe to talking about copper, because a big part of the idea of transitioning into a more electrified world is one in which we upgrade our grids, we make everything run off electricity, and we use renewable sources more, etc. Now, everyone who listens to this podcast, in fact, anyone who reads the newspapers, will know what a problem that is and the huge infrastructure demands that we have going forward. And that, of course, has affected the price of various industrial commodities, and copper is the classic, right, for the electrification of the world. And we've seen it hit new high after new high after new high. Is the solution to high prices there? High prices, or is the dynamic different today?
Copper does have a very unique outlook, actually, because, we can talk about electrification of the world and need for copper and other base metals in energy transition. But, before we started, let's just step back. Before we started talking about energy transition, the whole premise behind copper's rise or demand was purely about urbanization and population growth. That became less of a subject because we're all pretty much aligned that China has peaked in terms of its use for copper, incremental demand for copper for urbanization needs and population growth. And the question then became, 10 years ago, would the incremental demand from electrification demand for copper outweigh the decline that you would get from copper through demand declines from traditional demand? And the answer to that is yes. So if you go country by country and you look at what they're planning to do, their stated policies for electrification, and you add up what does that mean in terms of tonnage of copper, and you compare that to the declining copper through traditional needs, it offsets it. So it always had this kind of bullish story. And we've been talking about this for 4 or 5 years, even before COVID. COVID hits, we didn't talk about it anymore. We had lots of other things to worry about, including energy security and the cost of living crisis, etc. But a couple of things have changed in the last 2-3 years for copper, and it's given it an extra leg up. So the first one, of course, is AI and data centers, right? We talk about data centers and we talk about how energy intensive they are. But let's imagine you go inside one of these things. It's all about copper wiring. So the demand for copper from AI and data centers wasn't even talked about 2-3 years. And now we're talking about substantial amounts of copper needed for that. On top of that, we have to take into account the unfortunate geopolitical situation we're in right now, where everybody is basically trying to increase their defense expenditure. And actually, that is incredibly metal intensive, because you think about aircraft carriers, bullets, tanks, it's all metal, and copper is in everything. So,
it's even just the building of the factories, isn't it? I mean, let alone the products themselves, but the building of the factories requires large amounts of industrial metals.
Copper is literally everywhere. If I took apart this room we're sitting in, I'd find it pretty much in everything that we're touching or looking at. But you're exactly right. It's the building of factories as well. And you have to add into account, of course, hopefully successful resolution between Russia and Ukraine. And then we have to rebuild Ukraine. And that's incredibly copper intensive. If you look at countries in the past that have had to be rebuilt, the amount of copper that you need to do that is enormous. And you can look back even in World War II, where we had to rebuild most of the world, and that was incredibly copper intensive. So there's lots and lots and lots of things going on in copper that are supporting its price, not just one thing. So I'm not sure that the cure to high prices is high prices, which we generally say is the way that prices are going to drop. I have a hard time seeing how all of these things lose momentum in the short term here for copper, and I see it continuing to rally.
Okay, and how could the supply of copper go up fast?
Well, it can't.
What could we can't? It actually can't. There is no way to. I mean, obviously, it's verging on impossible to open new mines anywhere anymore, isn't it? Because of environmental regulation, etc. And so if you get one big mine that goes offline for a short period or whatever, there's no way to compensate for that.
Well, we do have inventories within Shanghai, the London Metal Exchange, the COMEX market in New York. There are inventories and buffers there. But, that's just what they're there for, as a moderate buffer in case there's a short-term shock, really. But if we're talking about long-term needs for copper to cater to all these things, we're talking about defense, AI, rebuilding countries, electrification, you need more copper to come out of the ground. And it takes ages to start a new mine, as you mentioned, for environmental reasons.
So should everyone have a couple of existing copper miners in their portfolio?
I don't think it's a bad idea. I mean, this is going to likely go on for quite some time. Obviously, nothing goes up in a linear bottom left to top right hand graph in terms of price performance. But it's one of these things that I'm having a hard time finding reasons as to why it would collapse other than a recession or even a depression. But there's too many things that are supporting it.
Yeah, although even in a recession, those defense facilities are just going to keep being rebuilt, aren't they?
That's right.
One thing recession is not going to stop.
Yeah, and let's get a bit macro here. You'd mentioned, copper's one of my favorite commodities because we call it Dr. Copper. It's the one thing that can forecast macroeconomic outlook. It's very, very good at that. But it's also very, very good at predicting a negative macroeconomic outlook. If we were running into a recession, you look at copper prices historically, and we can go back hundreds of years actually, well, at least dozens in the futures market, but in the spot market, we can go back hundreds of years. The copper market is the one that collapses before anything else when you're running into a recession. So I keep an eye on that for that reason, but it's very resilient right now.
Okay, let's talk about the other industrial metals briefly. And one of the things I mentioned earlier was that in this geopolitical environment, on top of the idea that everyone is rebuilding their defense industries, people are also attempting to rebuild their, well, in the West anyway, their manufacturing bases to rebuild the infrastructure that maybe they've lost over the last 20, 30 years as a result of relentless globalization. So if we've got that rebuilding and we've got people slightly concerned for all sorts of geopolitical reasons about all sorts of things, maybe stockpiling various metals, is it the case that we're not just talking about copper, we're talking about the entire industrial metal base being in a fairly intense bull market over the next few years, minimum?
Yes, some of them more than others. Nickel has always been a favorite as a potential bull market metal on the back of electrification. Of course, Donald Trump and the US administration right now kind of backing off from that has made that market a little bit less exciting. Also, nickel was previously used a lot primarily in building as a component in the steel manufacturing. That's less exciting right now because of the decline, if you like, or the slowdown in China. So they're not as exposed to all these very bullish elements as, say, something like copper. So that's a bit of an outlier. But having said that, you've hit on something very important, because another aspect of what is driving some of this bullish momentum, and maybe we can get into silver a little bit later, is
we are definitely on our way to talking about silver. Yeah. I'm literally gearing up for that right now.
It's about stockpiling, right? Critical material stockpiling. So, to go back to oil, what countries generally do with oil in terms of stockpiling is that they import 90 days worth of oil, put it in storage, and that's called their strategic petroleum reserve. That's how much they're supposed to hold in case something goes wrong. We don't have things like that for base metals. And so if one was to look at the countries that import things like nickel and zinc and lead, aluminum, copper, etc. And you said, okay, well, what if they decided to do the same thing with those metals that they do with the energy complex, notably oil, and buy 90 days worth of cover of what they normally import? You'd be talking about a tremendous amount of material that would put these markets in big deficits, and that would what would increase the prices. So we're not there yet in terms of critical material and the impact on things like zinc and lead, these smaller markets. But definitely copper and silver come up in this conversation.
Yeah. Okay. Well, let's go on to silver then.
Yeah, sure.
One of our favorite topics on this podcast. My co-host John Stepek is mildly obsessed by silver, so I'm sorry he's not here to talk to you about it, but let me do it for him. So, given everything we've just said, but also given the sort of stunningly sharp rise in the silver price, is that sustainable? Is this a bubble? And if it is a bubble, is it a rational bubble, or is this not a bubble at all?
Well, it's fascinating you say that. We try and be very quanty in our analytics at SocGen. We've got a model for almost everything, including bubbles. Is a particular market in a bubble? So I test these things out all the time. And a couple of weeks ago, we ran it through our silver complex, and it turned out the fact that we were in a bubble. And I thought, well, hang on a second. Have we been in a situation like we're in right now for silver compared to history? And the answer is no. What's going on there is the fact that silver, we have to remember, is basically 50% industrial and it's 50% precious. It doesn't move up and down with gold, but it can't move in a separate direction in the long term. So the gold-silver ratio is fairly volatile, which means that they do have different parts. But generally speaking, silver does do what gold does. The market is 10 times smaller than the gold market, which means it's way more volatile. The way I explain the silver market, it's just like gold, but on steroids, basically. If gold's going to go up, it's going to go up more. If gold's going to go down, it's going to go down with gold, but by more. But you have to add on top the industrial complex. Now, what's going on with silver, of course, is the fact that we've been running into 3 years of deficit. Now, before we got all excited about investing in precious metals and de-dollarization, central bank buying, etc., nobody really cared about the small deficits in silver. But once you start getting a leg up in silver prices and ETF buying and movements of silver from one location to another because of fears of tariff impositions, then all of a sudden the inventory of silver becomes incredibly important. And when you're in a market of deficits and you're expecting to have more deficits going forward, that's the support behind silver. Now, silver's very volatile. Is it going to come off? Yes, of course it will. Will it continue to rise? I think it will.
Okay, that's what we want to hear. And gold?
Gold, I have actually more conviction on because it's a much more solid market in terms of liquidity. And of course, central banks don't really get involved in silver at all, but they're very much in the gold complex. So I took a very interesting experiment because nobody really knows how much more central banks are going to buy, how long this de-dollarization story is going to continue. But if you take a list of all the central banks around the world and you look at see which central banks are holding lower amounts of gold relative to their total reserves. So some central banks, like the US, has 8,000 tons of gold. China has 2,300 tons of gold. So these are pretty big. But the really important question...
And we're sure about those numbers, are we?
No. We're not sure about the China number. These are self-reported by China to the IMF. We keep track of imports into China from London. We look at what they say they've bought, etc. So we go with the stated number, but knowing there's a little bit of probably uncertainty there. But I think the important thing is that even if you take that 2,300 ton number for China, that is roughly 6% of their total reserves. So if you're off by, another 2,000 tons, you're still below 20% of total reserves. And that's what most central banks are aiming to accumulate. So if you take the top, say, 50 central banks and you rank order them by the amount of gold that they're holding as a percent of total reserves, and you exclude the ones that are holding a lot of gold, and you're left with the remainder, and you ask this one question: what if those central banks moved 1% of their total reserves that are not gold into gold, just 1%? And you looked at all these different countries, whether it's the Philippines, Japan, China, etc. These are the countries that have low relative reserves. And you assume that they all did that, then you'd be talking close to 1,000 tons of gold being demanded. Now, remember, in any given year, normally, central banks buy about 700 tons. So if they made this incremental shift to 1,000 tons, in addition to the 700 that's being purchased, that mechanically would lift gold prices about $1,000 an ounce.
Okay, which would make the share prices of the miners go even more berserk than they've gone already.
Even more berserk. And by the way, we look at the cost of production of all the different miners, and they are all making money. There is not one gold mine that is making no money anymore.
It makes a pleasant change, doesn't it?
It does.
Yeah. So from your point of view, it is not too late to buy silver, to buy gold, or indeed to buy the silver or the gold miners?
I don't think it is. I mean, our house view is that by the end of this year, gold's going to be at $5,000 an ounce. Now, of course, we said that when gold was at 4,000. Now we're up to almost 4,500. I have a feeling, but I'm not sure when this will be, that I'm going to have to adjust that up again. If I adjust gold up, I'm going to have to adjust silver up.
Can you see any point in time in which the central banks would hold Bitcoin as a reserve asset?
That's a fabulous question. I have devoted a bit of time and attention of going to a variety of different central bank websites and looking at what their policies are on this, their statements, what they say they have, what they might do. I found two central banks that made a statement last year, the Czech Republic and Kazakhstan, that said they might consider holding Bitcoin or crypto in their portfolios alongside gold. But the key question was might. And I think it was the Czech Republic central bank that said if they did that, it would be a maximum of 5%. So it's a good question, but so far I'm not concerned about that.
Okay, so that is not a risk to your outlook for gold. What is the risk to your view on gold? What would turn it around?
A month, 2 months ago, I was asked the question, obviously with higher prices, central banks are going to stop buying because it just is just way too high. And so I looked at sort of elasticities of response of prices to demand across jewelry, across central bank buying, across ETF buying. And it's all basically broken, with the exception of jewelry demand elasticity, meaning if prices go up, people buy less jewelry. That is a very strong relationship. It's broken with central banks and ETF buying because those are the reasons why gold prices go up. So it's hard to think about an elasticity response when that is the reason why it goes up. So they are the causal influence. They have a positive elasticity, which means gold prices go up, they buy more. But so far, central banks have not reversed course on their statements as to how they accumulate their gold. They still say that this is a very strategic thing. It's not really about the price of gold right now. That's my concern, is if we if we see a reversal in central bank buying, I do check on it every month using HMRC gold export data out of the UK into places like China. It has slowed down, I will admit that, compared to, say, this time last year. I think if I see another 1 or 2 or 3 months of central bank buying decline as proxied by exports out of the UK, then I'm going to have to reevaluate my thinking on the role of central banks and gold demand for 2026. But so far, haven't seen that. The other thing that people often ask about is, what if we saw a massive reduction in uncertainty around the world? Geopolitical uncertainty, because those things are very highly linked to ETF flows. So the average person on the street like you and I, we don't go out and buy massive gold bars like the central banks do. The easiest way of us accessing gold is to buy a gold ETF that's backed by gold. And the relationship between uncertainty and ETF flows is through the roof. So uncertainty is measured in a variety of ways. There's lots of indices out there, trade uncertainty, geopolitical uncertainty, et cetera, et cetera. You can go on the web and find these things everywhere. My favorite is economic policy uncertainty. It's an uncertainty index developed by some professors at the University of Chicago. You get daily versions, weekly versions. And if you plot it alongside ETF flows, they go up and down together. So the question is uncertainty likely to come down? And my answer to that is no, not at least in the next 3 years.
I can see why you might feel like that.
Yes.
Listen, let's go back, if you don't mind, to energy.
Yeah.
And how is it best for an ordinary person to invest in the energy markets at the moment? I mean, it feels like it's very, very hard to forecast the oil price. I mean, you said that forecasts are all over the place and nobody even knows whether demand is going to be up or down over the next decade, etc.
Yeah.
So if you want to be invested somehow in energy, where do you go? I mean, obviously, copper is a good answer, but an answer that isn't copper.
Yeah. Well, so for, the simplest, I use inverted commas on that, is to access the energy complex through things like ETFs, or even if you're a little bit more sophisticated, buying or selling futures or options on futures. The problem
No, we don't want to do that. We absolutely don't want to do that. We are simple people here. We're simple people. We want to buy an equity or we want to buy an ETF.
Yeah,
and we want to buy a straightforward, properly exposed to the physical ETF. Nothing else. We're simple people.
I mean, this is probably the most sensible way of accessing these markets. Now, I do happen to be bearish on oil going forward, in case I didn't mention that before. So I wouldn't probably...
No, you weren't quite clear enough on that. That was pretty much what the question was. You weren't totally clear that you were bearish.
Yes, so I'm not sure I would recommend that to people. But if you were in the interest of getting access in that, I think going through the energy companies themselves, or at least an ETF linked to those companies, is the most sensible. But I would stay away from the actual flat price of energy through futures and options, because we have funny shaped curves, the forward curve, and if you invest in the front, you're going to lose money as it rolls down the curve, etc. So stay away from that.
We don't do that. What about the oil services companies in the US? Now, they, for this very reason, things we were discussing earlier with Venezuela, and they had a bit of a pop after the incident. What about those?
I'm not an equity analyst, so I tend to stay away with making judgments on particular sectors within energy, and particularly the companies themselves. But you'd have to imagine, aside from Venezuela and potential opportunities there for using US energy services companies, if you're talking about a market that is going to go through some sort of bearish cycle, which is what I think it's going to do in the next year, at least, maybe 2 years, is I'm not sure I would look at those sectors.
Okay. And can we just go back briefly to the bearish cycle? Because I don't think we completely covered it when we were talking about oil. That is based on what? Because we don't expect demand to fall off over the next couple of years, but you suspect...
we don't expect demand to come off. It's not going to go negative, but the rate of growth is slowing every year. And it will slow all the way up to 113 million barrels a day, as I mentioned before. But it's about the supply side. So OPEC has been cutting oil production / exports to keep prices at a high enough level so the cost of extraction in the OPEC members is fully covered, but also the social costs within each country is covered. But at some point, they've given up and they've said, okay, we're going to produce more because we want more of the volume that we've been holding back on, which enables places like Brazil, Guyana, the US, and Canada to enjoy that incremental demand growth by adding that supply. So they've reversed course and said, we're not doing that anymore. We're bringing back oil into the market. So when you add in what the developed market is producing, when you add in what OPEC is putting back into the market, and you subtract from that the incremental demand that we might get next year, we end up with a surplus of about 3 million barrels a day on a 104 million barrel a day market, which is gigantic as a percentage. And because of that, that means that inventories build around the world, they swell up, we've got plenty of oil, and prices collapse. The reason why they haven't collapsed right now is because China has been buying oil for its strategic petroleum reserve, which is a whole different conversation in itself. But when they stop, that's when inventories kind of grow rapidly, and that's when prices come off next year.
Okay, so this is absolutely fabulous news if we think, as we do, that, all activity is energy transformed. The cheaper energy is, the better for everybody. And we know so many horrible recessions have been prompted by high oil prices. Seeing oil prices go lower, and they're not exactly high in historical context at the moment, seeing them going lower will be absolutely fabulous for global economic growth.
It totally will. I mean, I'm not talking for a collapse in oil prices. Our official forecast is it goes for Brent anyway, which is the more global market, to go to about $50 by the end of the year. And we're at 60 right now. So we're not talking about a 20 or a 30% decline. And if I turn around and I tell my economists, hey, I've got some good news, oil's coming down, what does that mean for inflation? What does this mean for GDP growth? They don't get overly excited by the level that I've just explained there. But obviously at the margin, this is very positive for people's pockets.
Excellent. Brilliant. Thank you, Michael. See how we ended there on a positive note? See how that works?
We're done?
We are. Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Summer Sadi and Moses Andam. Sound design by Blake Maples and Aaron Casper. And special thanks, of course, to Michael Haigh.